Hello everyone, welcome to my channel, and today I'm going to discuss 3 UK stocks that could massively benefit from Rachel Reeves' new spending report for housing. So today I'm going to run through what she announced on the basis of the housing, what that could mean and the risks for the market still, because all stocks are going to be in the same market, and then run through the stocks individually, look how they've been performing recently, the outlook, the guidance, and anything else you may need to be aware of. So yeah, let's jump into what Rachel Reeves has said. So she's announced a new affordable homes program which will result in investing £39 billion over the next decade. So this takes the average spend per year from 2.5 billion to 3.9 billion. So this will massively benefit those who build for social rent, and it is also to help achieve their promise of building 1.5 million homes that was submitted in their manifesto. So 9.6 billion is to be used to finance private home builders. 4.8 of that is for England specifically, and major house builders are anticipating 3% to 8% growth year over year after the announcement of this new spend budget. Before we jump into this any further, please remember that this is not financial advice and your capital is at risk when investing. Please do your own research before investing in these stocks, and this video is for information and entertainment purposes only. Okay, so the first stock I want to bring to your attention is Barrett Redrow. So these have merged with Redrow in February 2024. So they actually have 3 brands under their name. So Barrett, which is for first time buyers and families, David Wilson, which is for family homes, and then Redrow, which is premium homes. If we look at the stock price at the minute, over the last 3 months, it is up 11%. Off the back of the news this week, it is up 7%, but over the last year, it has traded sideways. So let's dive into them a little bit further and see what's going on. I just want to highlight that at the minute, they're trading with a PE ratio of around 45 to 50. But their forward PE is expected to be around 16, so that shows that they are really going to grow into their earnings, or expected to grow into their earnings anyway. I really want to look at the margins for Barrett. So Barrett actually has quite tight margins. So as you can see, the return on invested capital is only around 2.5%, and the return on capital employed is only around 4%. Gross margin sitting around 15%, and that has grown over the last 10 years, which is quite positive. Operating margin and net margin has come down a bit, but I don't know if obviously they've just gone through a merger recently, so I don't know if the finances need to settle a little bit. But I would like to see their return on invested capital and return on capital expenditure to be increased. Another key fact I want to really point out is they don't really have much debt, so their equity ratio is 0.03, so that's quite good. They also announced in February that they intend to buy back shares, so that's 50 million shares that they're going to be buying back. The dividend yield is around 3%, but it's not safe. They're just getting enough capital to cover that dividend. So yeah, it's not a safe dividend paying stock, and it'll be interesting to see what happens going forward. But the strength of Barrett really is it has a strong balance sheet, its integration with synergies and solid guidance. It has analyst support, share buybacks and forward house price benefits, and it has obviously the potential benefit from government housing policy. But the way it's priced, it's really got to perform well. It's not undervalued in any way, it is sort of valued. So if we look at the valuation of Barrett, you see in a base case scenario it is 4% undervalued. In a worst case scenario it's 31% overvalued, but in the best case scenario it's 50% undervalued. So really they need to perform in line or perform better, or this could see some negative effects on the stock price. But yeah, that's it for Barrett. Let's jump into the next stock. Next, we're going to talk about Taylor Wimpey. So Taylor Wimpey are a big player in private and affordable homes. And if we look at the stock performance over the last 3 months, it's up 9%. but over the last year it is down 17%, so it's took quite a hit. I believe this theme appears to be throughout UK housing, so it looks like it took a hit last year overall. But yeah, so for 2024, 22% of all completions were affordable housing, which is quite a healthy chunk. And one of the strengths of Taylor Wimpey is they are strong at acquiring land at good value, and we either develop this land or they sell it on to other developers. So not only do they sell within England, they also have a Spanish division, so that's interesting. And they're normally building like Costa del Sol and I think this said Costa Blanca off the top of my head, which are two popular areas in Spain with people who are trying to move abroad. So if we look at their finances, revenue is sitting at 3.4 billion and is expected to grow over the next few years. We can see up to 30% growth over the next 3 years. Free cash flow appears to be quite low. They do have a policy, which I've just found in the trading statement, that they have a dividend policy to return 7.5% of net assets annually within their dividend, so that's quite interesting. So if we quickly jump to the dividend stat, also that is right. So they've got a 7.7% yield currently with a payout ratio of 154%, so they're paying out more than they can afford, and the dividend growth is negative, not positive. But I don't think you'll actually see much dividend growth with Taylor Wimpey if their policy is to only return 7.5% within the dividend. If market conditions worsen, then the dividend is at risk because they're literally they're not even covering it at this point. So that's quite interesting. But if we take a look at their margins, their gross margin is sitting around 20% with a return on invested capital at 6.3% and a return on capital expenditure at 8%. So this is higher than Barratt Redrow, and that is obviously positive. The revenue and profit was down for the financial year 2024. Its build count was lower, but for this year it is expected to be higher. So they've got £2.3 billion on the order book, which is up from £1.9 billion last year, and they are expecting to build 10,400 to 10,800 houses this year. I believe it was 9,400 to 9,800 last year, so that's roughly 1,000 more. And they have 83,000 ready plots. Obviously, they're not going to build 83,000 homes, but that's 83,000 ready plots that they can build on or sell to other developers. I do want to point out that the revenue and earnings per share has fell 2 years in a row, and it is trading towards its 52-week low, just like Barratt. But obviously, with all this extra funding coming from Rachel Reeves' spending, they're in quite a good position to win some of the contracts and take advantage of that. But yeah, if we look at the targets for the next 12 months, Wall Street has it as a 1% downside, 21% upside, or 51% upside in the best case scenario. So really, analysts don't see much downside. And from my research, a lot of analysts are expecting 30 to 49% upside. So they're sitting between these two really, which is obviously good for investors. If we take a look at the dividend, as you can see, it doesn't have a safe dividend score. The dividend yield is around 7.7, which we looked at on stock analysis. But shareholder yield, which is totaled by dividend yield plus buyback yield plus debt pay down yield, is 7.7%. So that's a healthy return. So yeah, if we look at the intrinsic value, which is the last thing I like to look at, based on alpha spread. So obviously this isn't accurate. Well, it's not that it's not accurate, but just take it with a pinch of salt. Work it out yourself. In a worst case scenario, the 40% overvalued. Base case scenario, the 10% overvalued right now, but intrinsic value is 31% undervalued in the best case scenario. So yeah, I do think Taylor Wimpey are in a good position to take advantage of this extra spending, but we'll see what happens. And the final stock that we want to look into is Vistry Group PLC, ticker VTY. So if we first look at the stock performance recently, it is up 16% over the last 3 months, but a lot of this is off the news, so it's up 8% off the news this week. Over the last year though, it is down 43%, so that's quite a drop. But who are they and how did they make the money? So they are a group that not only builds their own homes but works with partners to build homes. So they work with 150 housing providers to deliver multi-tenure affordable housing. So if we take a look at this image here, they focus on delivery of homes of all tenures. So this includes literally everything. So social rent, affordable rent, supported housing, extra care, rent to buy, share ownership, first homes, discounted sale, private rented and private sale. So there is not a market that they don't have their fingers in, which is obviously quite good. So this diversification allows them to target broader markets, and this reduces cyclicality risk and provides more resilient revenue streams for the company, which is obviously a massive boost. And last year they approximately sold 35% to private customers. The rest was through social or affordable housing or through other partnerships. So if we take a look at their financials, revenue over the last 3 years has grown 57%. Over the last 5 years, it has grown 234%, but it's up 6% in the last year. That's some quite good growth. Operating income has took a hit recently, but over the last 5 years has grown by 45%. Earnings per share has also took a hit, but it'll be interesting to see if they start recovering that like estimated. Free cash flow and operating cash flow is quite low, but I think that's, as you can see, quite common in housing companies because the margins are so tight. So if we look at their margins, their gross margin is sitting around 10%, so it's nearly half of what Taylor Wimpey's was. Return on invested capital is around 4.5%, and return on capital expenditure is around 6%. So yeah, they are low, and that just demonstrates how tight the margins are in the housing industry. But as you can see, all of these metrics have grown over the last 3, 5 and 10 years. So yeah, it's nice to see that growth is there. If we take a look at Wall Street's targets, on the lowest end, you can see 33% downside, but on the upper end, you can see 19% upside. If we look at their trading report, they have announced that it maintains its expectations for the year, and since the March announcement, sales have increased, and so has the forward order book totals, but these are both still below the 2024 figures. So this could show that they're still in for a rough 2025 figure. Units secured increases by 72% for the financial 25 years, but they believe that they're in a good position going into 2026, and the government's announcement of an additional £2 billion of top up for affordable housing will be allocated through the existing affordable homes programme, but this will start to hit the books between 2027 and 2029, so that's more forward earnings to look to. But it says they are well positioned and are working closely with a range of partners to identify the best opportunities to secure funding and deliver much needed affordable housing. However, they have noted that they can see some upward pressure on material and labour prices, which they're trying to mitigate where possible, but that is also a risk, is the price of materials and labour staying high or going higher. If we also go back to the financials, so for 2024, revenue was up 7%, and so was completions, but profit and earnings per share was down 35%, and this was due to an issue of forecasting the costs in the Southern Division. So obviously that took a big hit last year, but hopefully they don't have that issue again. I believe they're in a better place now, but the debt has increased by 100 million, and the dividend has been halted due to the poor performance. But the last thing I want to look at again is intrinsic value. So alpha spread states in a worst case scenario it is 10% overvalued. In a base case it's 30% undervalued. and in the best case, it's 59% undervalued. So quite an interesting one. Obviously, this isn't financial advice, but for me, this appears to be the best placed company. If you are looking for a dividend stock, these obviously don't pay the dividend, so you won't get that, but both Taylor Wimpey and Barrett do, so that's quite interesting. Obviously, we need to remember that there are risks associated, and all three are exposed to the same risks because they're in the same market. So the first one is high inflation. Obviously, if inflation stays high or gets higher, that'll put pressures on people buying. High mortgage rates, obviously that's a given. If people can't afford the high mortgage rates, which is why a lot of people are in this crisis, so these need to start coming down. I believe they are coming down. I know people who are buying a house right now and they're constantly being sent new paperwork to sign because the mortgage rate has come down, so you just want to continue that keeps on coming down. Obviously every business is going to have to deal with labour and material costs. These are quite high. If they stay high, or if the tariffs start having a negative effect on these prices, then the price of houses will soar and the amount of customers that can buy will reduce. But yeah, them risks apply to all three companies, and that is the major risks with housing companies. That's been it for this video. Please let me know what you think below, because I think housing companies are such an awkward stock. They're just awkward to analyze, really. The margins are really tight. A lot of the funding is linked to government spending. So yeah, let me know what you think. If there's any that I haven't looked at that you think I should look into, leave a like if you have enjoyed, and I'll see you in the next one.